Hi, this is Randy Finney with Right Side of the Chart, and today is Friday, March 24th, 2023. It's 11:55 a.m. Eastern Time, so we're about right in the middle of the trading day, and I wanted to just do an update here. I'm going to talk about in this one, just keep it limited to the stock market, and then anything else that stands out, I'll get it out to you. But recently, I've covered a lot of the individual trade ideas in different asset classes. I've done updates on the precious metals, gold. I've thrown out more individual stock trade ideas in the last month or so than I have in quite a while, and I continue to maintain that. Lately it has been, and that's why I did it. I believe it would be a stock pickers market. And, the indexes. We're starting out here on this monthly chart, but you can see the candles were really compressed. So swing and trend traders, especially investors, 401k type money, is going nowhere for the last few months. And again, you want to make money when you try to recognize when those periods are going to come, and that's when, at least me personally, I would start shifting a little away from focusing on trading the stock indexes and these big runs, the big rips and dips in a bull market, the bigger trends. When they're when the market's set up, you can trade the stock index futures or the ETFs, SPY, QQQ, or any of the leverage versions if you want. And the nice thing about that is you don't have to scrub your positions for earnings. It's not as hard to manage. What I mean by that, when you trade individual stocks, you better know when they report earnings. You don't want to, I can tell you from experience, early on, plenty of times woke up on the wrong side of a gap because I didn't realize the company I had was reporting. So I've learned, it's a little more work trading individual stocks. You want to scrub that, make sure you're not holding into an earnings report. Again, if depending on the nature of the position, some stocks do such a good job of managing earnings expectations. There's very little, if any, surprises, and then others have a history of making big moves after that. So again, there's a lot to it, but it's just more work. And then of course, managing a portfolio of individual stocks and many different things is a whole lot more work than the indexes. Okay, so with that being said, that's where we've been at, and I'll continue to update and throw out new individual stock trade ideas, focusing on as well as the most bearish and bullish sectors. But I wanted to talk a little on the markets today, and just keep in mind when I'm talking about the charts, this is technical analysis. Technical analysis is analyzing charts and other information, and volume and moving averages and all that good stuff here that we can see visually. And then I also always try to interject my background in fundamental analysis as both a business major and a former stockbroker, financial advisor. I'll give you my thoughts on the macro picture. And so if I'm talking about the Fed or what Yellen may or may not do and all that stuff, and where the market's going to go from there, that again, that's fundamental, and that's more of whatever. I try to incorporate it into my both my active trading, but more so it's more so for the bigger picture. Although right now it can certainly has the potential to change the trajectory or the outlook or the technicals and the charts. In other words, if some big saved by the Fed, and that's what I wanted to talk about, or the Treasury Department. They're saying Yellen may come in with some plan to save the backstop the banks or do something else. I'm just going to talk fundamentally real quick. This is, in my opinion, I think of many others, probably one of the biggest bubbles that the Federal Reserve and really the government as a whole, all entities, the Treasury, has created in modern history. And there's really I don't think there's any parallel to it. The Roaring Twenties was similar, but there is this, and this is just me talking, making observations lately. What I've seen just in the last couple of weeks, since the collapse of Silicon Valley Bank, and of course that being then deemed all of a sudden it wasn't systematically important before. Number one, tells me the Fed has, and I've always said this. Sorry guys, I'm a big critic of the Fed. They have no flipping idea what they're doing. They're supposed to be the ones managing the banks, and they didn't know this was going on, and they didn't know they were going to break the system, raising rates as much. They didn't realize, create that, holding rates near zeros for 15 years would create excesses in the system and imbalances and create a lot of speculation. But anyways, let's not go there right now. You either pro Fed, anti-Fed or somewhere in between. I just think the folks, running the Fed have no clue what they're doing and ultimately going to make things worse. But let's talk about that real quick. Again, the risk now, and here's my interpretation of what I've seen lately. Since the collapse of Silicon Valley Bank and all that, you can see it was the here. You just want to go back. You go. It's no longer trading, so you can just see the day it started plunging was the day that KRE started falling. So that was the March 9th. So you can see up before there, the regional banks were at support right here, the support level, and that's where they broke it. This 55.61. So really everything was hunky-dory, and it wasn't a problem back on March 8th. Okay, so let's just for a second go with this. If I vehemently have stated and believe that there is no net positive to this. The market is now, I think, spinning it that we have a potential banking crisis as a net positive. Why? Well, it's classic conditioning. Pavlov and his dogs. This goes back to 2008. That every time we've had a financial system, a problem in the financial system, any cracks or big corrections, I think fourth quarter 2018 when the market started dumping because of throwing a taper tantrum because the Fed tried to start hiking rates back then. They've come in, and the Fed has come in with some drastic measures and pretty much prevented any type of recession, real true recession or a true lasting bear market that flushes things out for over 15 years now. Okay, and so I get it. There is that the market almost, and we can see it because again, here I'm going to show you. There's the what I say, March 8th right there. Now let's go to QQQ, because what I've seen is, and this is to me, I'm sorry, it's insane. I've seen crypto rally hard. In crypto, you have your thoughts on it. I have mine, but I've seen speculative, the riskiest of assets in tech stocks rally. All of a sudden, for the first time, I'm seeing that FANGs, Apple, Microsoft, Alphabet, Amazon, these big mega tech stocks are all of a sudden flight to safety assets. And that's insane. It's always been the other way around. And in times of market turmoil, a recession is, by every metric that I follow, including but not limited to the yield curve, baked in the cake. Especially now, since what happened with the banking system and the Fed backstop, it's widely acknowledged it's going to make credit harder to obtain going forward. So if anything, here's my point. If anything, what happened in the last couple weeks with the banking system, any way you want to spin it to me is a net negative, but yet the market's taking it as a net positive because the Fed's going to come in with some extreme measures. We're going to see quantitative easing again. And you know what? Maybe that'll be the case. But I'm betting 15 years into this, and without the arrows in their quiver, that's not going to be the case. So, I told you yesterday, I told you, I think 2 days ago, that I'll be going home short into the weekend no matter what happens today. Yes, the risks are unilateral or bilateral, meaning that if there is some big invention, even if I'm right in the longer term and it just creates a brief short covering rally and a relief rally, it could be powerful. And so, I'm not going to tell you what to do. I'm telling you what I'm doing. So there is that risk that over the weekend something comes out and there's a big pop in the market on Monday. But I also think the risk reward, I think that pop would be fleeting because ultimately the markets are going to turn to look at the the bigger picture. You're not going to see the stock market climb in a recession, and the recession hasn't even yet started. Again, maybe I'm wrong, but I think it's almost near certainty, baked in the cake, that we'll be looking at a recession, and a different one than that we've seen in many years. I think it'll be a lot longer, prolonged, and whatever. So I'm right or wrong, we'll see. However, I think the risk reward, despite the fact the markets can either gap down and crash next week, I'm leaning that way, or they could pop up and rip on some government intervention. But again, I want to show you here that, here it is, the March 8th. Here we were right here. There's the day we dropped. That was the day before. So that's when Silicon Valley Bank and all the rest of them, everything that's happened then, and then Credit Suisse. Today, Deutsche Bank is getting, hammered pretty good. So yet the NASDAQ 100 has climbed from that day into the post Fed peak right there, rallied about 6%. And again, my point is, maybe I'm wrong. I see it as nothing but a net negative. When I say net negative, sure, there's some positives in there, and you're shoring up those, um, the regional banks from being wiped out, or at least that most of them. And of course, I've gone over this. You can look at the charts. There's still a lot of them selling down, and the market, the smart money is sniffing this stuff out right now. So, all right, I just wanted to say that this, to me, is a opportunity. It's in my opinion, again, a misfound or an irrational assumption that these big market leading things, because they're tech companies and they have nothing to do with the banks, this is just a bank problem. Therefore, those stocks should rally. That people should move into there as a whether it's a flight to safety. Again, it's hard for me to even say that to tech stocks. These are the ones that tend to come down hardest in corrections and bear markets, or whether they think that there's some net positive in the economics, in the macro picture. That's going to Apple and Microsoft are going to sell more products and services and be a beneficiary of this. So that's why I do think I'm not always going to be right, but I was correct back here. Pretty emphatic and adamant in position that the big tech would lead the way. Would not only rally when the markets were clinging down, challenging the previous lows, but that the big tech would lead, and that was 110% the case. Big tech and the market leading, FANGs outperformed everything else, and they've been outperforming lately with the S&P down since the 8th. Again, let me just show you. There's the candlestick on the 8th, right before Silicon Valley Bank. It was a little bit of a sell down in tech, and then money's flowed into it and it went up. But of course, the S&P 500, remember, the NASDAQ 100 has virtually near zero, very little, if any, exposure to the financial sector and the banks. So therefore, that's one reason you've seen that. But again, it's not that it just stayed where it was. It actually went up, and that to me is, again, an opportunity to short. I think it's going to. The market reality will catch up to it. Here's the S&P 500. There's the 8th. There's the red sell-off right there, when it all started. And we are down, but we're not down that much. We're down 1.5% from where we were the day before the whole Silicon Valley Bank thing became apparent to the masses, right? Again, based on everything that's happened over the last couple weeks, and again, this is just me, I view it as no net positives to the economy or to the stock market. Yes, they might have saved a much larger banking run, a contagion. They might have helped eliminate that, or reduce, a crash-like scenario. But again, I see no net positives and nothing but net negatives. So in other words, if that's where, just making an assumption, things were fairly valued then, I think I don't think they're reflecting, especially the tech stocks are not reflecting, in my opinion, that things have changed for the worse since March 8th. Okay, anyways, that's my fundamental rant. Now let's just get to technicals, and I'll wrap this up so it won't be super long. This is the S&P 500. This is what I consider, I have different draws of trend line. This is a monthly chart we're on right now, and there's what I consider probably the best fit, if you will, of a bull market uptrend line. So by that one definition, the S&P 500 still above trend, still in one of the longest and strongest bull markets in history. Yes, we have technically already well exceeded the definition of a bear market, especially on the NASDAQ, by the drop of over 20% off the highs. Yes, we're above other trend indicators that I do consider us being in a bear market. Okay, so there's different ones. I'm trying to show you the big picture. But this is pretty much the last of the big support levels that I think will most likely trigger the next leg down and to take out the October lows and extend the bear market. And also at that point, I think you're likely to see a return to the pretty swift and powerful and unrelenting selling that we've seen in previous bear markets at some point. That's one thing this bear market's lacking. We've had some pretty good moves down, some pretty good trends, but it just doesn't feel like, of course, nothing remotely close to what I, recall back then in 2008 or in the previous bear market before it from 2000 to 2002. Nothing like it, especially the bottom. We're missing. There were some signs. Some of my indicators hit the buy points on the put to call ratios and other things like that. But I do have a lot of indicators that never made it there. Percent of stocks under the 200 days. I covered that in the last week or so under my breadth indicators video. All right, so let me show you what I can tell you. We are below the big levels to me are these the dash blue line here, the 20-month exponential moving average does a great job of defining bull and bear markets. We solidly took it out there and have yet to solidly recover it. We've been back testing it and closed on it there, got rejected on it there, closed below, got rejected off it there, closed well below, stayed below the following month, closed on it, got rejected, closed on it, and we're below it. And we're also, I put up, I've been also looking at the 20-month simple, and that also can do the same job. The exponential just responds a little faster. So by that metric, the both the simple and the exponential monthly, which again, I've encouraged you to do this, it is probably the best single 401k indicator out there I know of. Nothing's 100%, but it's just super effective. When you are below it and you want to wait for a monthly close to cross or monthly cross above to flip it, you would have immensely outperformed the S&P 500 by being long when you're above that and then getting out of your longs and or going short when you're below it. You would have captured the bulk of every bear market, and you would have certainly captured the bulk of every bull market on the right side of that trade there. And so that's one. But again, problem with indicators, they work great, and at some point they stop working. So you can't put all your money into it just because it has a good track record, but I put a high weighting on it. All right, we're going to step down now, and you can see the other bull market uptrend lines. Nothing goes up forever, right? Bull market, bull market, bull market. And you can look at this bull market and just, you don't have to be an expert technician to say, something's a little bit different about this bull market than the others, and it's how long and strong. And again, it's because you had a Fed that somehow it appears they think they discovered the the holy grail, and that's just keep rates at zero forever, and every time the market looks like it's going to correct or there might be a recession, throw everything we have at it and prevent that. Well, that creates excesses. It just leads to a bigger bubble and more to drop. Let me show you one more chart. Let's just look at the S&P 500. And again, this is what goes in. I've talked about it many times before. What goes into my longer term analysis too is, and this is where I marry fundamental and technical analysis, is interest rates. And I cannot emphasize enough, this is economics 101. This is stuff, if you didn't learn it in high school and you went to college and you took some business courses, you know what there is. That stocks, the equity market likes falling interest rates, because as rates go down, two things happen. Number one, the cost of capital becomes cheaper, and you can buy a bigger house, you can buy a nicer car, you're more likely to get qualified for a mortgage because the payments are lower when rates are lower, businesses expand, etc. And obviously it goes the other way when rates go up. So that's 101. Then the other component of it is opportunity costs. People buy stocks. There are people that are pure risk taker, and there are grandma that only wants her money safe in CDs. Well, the Fed and the Fed has said this. It's something known for many years, but Bernanke came out and said it in 2008. One of the reasons to take rates down to zero or lowering rates is it forces those people who are marginal or need the money, out of those safe haven government bonds, corporate bonds, and CDs that were back then paying 7-5%. And when they take your CD rates down to zero and your government bond rates down there, you're forced to replace that yield. So then those normally safe investors, including but not limited to pension funds and the likes, they move into dividend-paying stocks. They move into junk bonds. They move into things that they have to replace that yield. And so there's that direct correlation of falling interest rates are good for the stock market for that reason as well. So I just give you two reasons why falling interest rates are bullish for stocks and rising interest rates are bearish. Okay, so that's, again, economics 101. That's not a debatable topic. It's not my opinion. It's just it's fact. Again, taught in economics 101. Edit chart properties. Let's go here and look at the interest rates. We'll use the 10-year. You could do the 30, but the 10-year is actually, the 30-year mortgages tend to track the 10-year treasury bond yield. Treasury bond yields better than the 30-year. And what you can see here is there was a period back in the 60s, 70s where the market, you had your bull and bear markets. And this is log scaling, so it doesn't look like much, but it was pretty much a flat market, and we had some really a bad bear market and recession from the 60s, mid 60s, all the way into the mid 70s. It was almost 10 years, two big bear markets, and we kept going lower, and that was during a period of inflationary rising rates, and rates peaked right here in the early 80s, 1980, 81. That was the peak, and from there we had the biggest, or at least in modern history, the most powerful secular bearish trend in interest rates. Again, these are the 10-year rates. I've talked about this, and by every metric, that's over now, and we've most likely begun a new cyclical bull market in rates. So that massive, and again, it's natural forces plus the Fed, and then the Fed really came in here and got crazy and abusive, if you will, in their powers and overreaching, and they've created just this massive bubble. And look, over time, I'm going to be right or wrong on my theory that we've now are in the very, very early stages of a new upward trend or secular bull market in rates. And if that is correct, we're not looking at another 2007 to March 09, 18-month, 15-month bear market like we had right there, or the one back here, which was less than 2 years. We'll be looking at something much longer, much worse. And I just wanted to point that out. This very, very much goes into my analysis and my longer term thinking. So, I've laid out from day one, before the bear market started, I laid out targets. I was most focused on the NASDAQ 100. I gave you 4 targets, and this is really still kind of what I'm referring to as my initial final bear market target. It's just where I do think over time there might be more, and there's a major trend line. And the thing is, once if we get to these targets, we're going to have hit or taken out some of those longer term trend lines. But either way, that's just what I'm looking for the next leg down. That moved about 235, 236 on QQQ. We already hit T1, T2, T3, and T3 was right here. I'm sorry, T3. And so I think that's coming. And again, well, all day long, I welcome bear markets because they're like bull markets and fast forward. You can make so much money. The rallies are very powerful. They're well into the double digits in just a matter of weeks. So you can make 2-3 times the average annual return of the S&P 500 just catching these little bear market rallies, even if you don't short. But if you short, it's just all the better. So and then volatility expands too. It's the it's a active traders market, or playground, if you will. When you have this kind of increasing volatility. So, alrighty, I said my piece. As far as both technicals, let me just show you one more thing. So I showed you where we were at under the 20-month exponential moving averages, both of them. I'm going to the weekly chart here and show you on SPY, because that's more indicative of the stock market than the NASDAQ 100, of the overall stock market, because it's more inclusive of all the sectors. And you can see here, today is Friday, so we have now less than 4 hours to go. And here's the 200-day exponential in red, the 200-day simple. We took out, remember this whole thing, I suspected it would be, and as of this point, it is a false breakout a lot. And I would say more people, professionals, individuals, use the 200-day moving averages than just about any other indicator I can think of. I mean, Fibonacci, Elliott wave, even trend lines. This you'll hear about often. You hear about it and forever and a day on on financial media. People quote this, and they considered this, and maybe they'll be right. That was very bullish that the markets took out the 200 days. But guess what? It did as of now. Actually, I'm sorry, my mistake. As of 2 weeks ago, that breakout failed, meaning we went down below and made a solid close back below the 200-day. And I'm sorry, guys, I'm on a weekly chart. It says 40-week. That's the same thing. I always say this. There's 5 calendar days in a week. So if you take 40 times 5, that equals 200. So the 40-week on a weekly chart, or the 40-period moving average, is the same as a 200-day moving average. And so I just wanted to point out that we broke above it here. And once it was clear, we took it out. The market rallied. They came and back tested, but then failed week before last. Last week, failed to recover, tried to regain that 200 simple, got rejected, closed below it. As of now, we tried this week to regain both, and as of right now, we're at 392.08 on SPY. We're back below it. Not a be-all, end-all, as I've said before. You know, you'll get whipsawed to hell saying, "Oh, bullish, let's go long and put all my money in my 401k into stocks." No, I said it's incremental. The farther you get away from it, really at this point, bulls need to take out the recent highs, and bears need to, as I've been saying for 2 weeks now, take out the low from Monday before last, the recent lows there. And then I think that will just trigger a flood of stops. I make few guarantees in this business, in this game of trading, investing, but I can all but guarantee there were a lot of longs that piled into stocks when the 200 days were taken out. And those stops are and have been hit and will continue to be hit. And then short sellers or flexible traders like me, I'm just as comfortable being short as I am long. They're like sharks. They'll smell blood in the water and they'll start jumping back into short positions if that gets taken out. So that's it. So I think we're at a critical juncture. I don't think the Fed, I'm not, to say I'm not concerned. If I was very concerned about the Fed, you know, or Treasury doing some type of, you know, save for the markets here that was going to blow me out hard, I wouldn't go home pretty aggressively short in the weekend. I am personally. I can't tell you what to do. Somebody asked about that. You know, hey, Randy, how short should we be right now? I can't answer that question. 20 years ago when I was a financial advisor, I could, but there was something called, if I was your financial advisor, there's something called the know your client rule, and that is, it's now called, back then it was something under SEC, and then they had FINRA come, since I was in the business, it's now FINRA rule number 2090, know your customer, and then there's FINRA rule 2111, which is a suitability rule. What that meant is if you came in, I could not make a recommendation to buy Apple or to put money in bonds, do your asset allocation model, or make any recommendation without thoroughly knowing your background, how much money you have, what are your debts, your liabilities, you know, is this every penny you have to invest, or do you have a lot of money elsewhere? What's your risk tolerance? Are you conservative, aggressive? So I can't answer that for you now, and I can only tell you, all I can do is do what I do on this site, provide technical analysis, share my fundamental thoughts. I'm always more than glad to tell you what I'm doing, but that is not right for you. I might have a lot more cushion. You know, I'm playing with a lot of the house's money that I've made in recent years. I've taken money from the house, and so if you go to Vegas with $1,000 in your pocket and you have a few good hits on the roulette table or whatever, and you're up to 20,000, you got a lot of the house's money. You can maybe afford to lose 5,000. But if you don't, then you can't afford it. So anyways, that's, everybody's different. So I can tell you right now the risks, this market could break either way, but I think we're at that point where Fed is now, a lot of the arrows are out of their quiver, especially where we're at with both their credibility about just recently being full-blown hawkish and trying to make a pivot right now without losing too much credibility by pivoting too fast. So I'm not really, like I said, I think the risk reward is favorable to the downside, because I think the risk of a pretty big sharp move down in the market, especially based on where we are technically, outweighs the risk of a huge move up, especially anything more than just a knee-jerk reaction. If they come out with something over the weekend, futures gap, spike up on Sunday night, the markets pop up on Monday, my guess is that's a rally that would be relatively short-lived, whether it's hours or days. and then get sold into again. And if I'm wrong, then I'm wrong, and I'll, the first thing to tell me I'm wrong is going to be the technicals. I look at the charts. I jump down to a 60-minute chart, and what I can tell you is you have the primary downtrend line on SPY, very well defined, short term from early February, but a lot of reactions. We got rejected there. Then we got the next, and we also got rejected on the back test of that trend line right there off the, actually that trend line goes all the way back here, but especially in the late December, early January lows. So here's the levels I see. I know this chart looks busy, but downtrend line rejected. Uptrend line right there, we broke down below, we back tested twice, got rejected, and then more recently we broke this minor downtrend line or wedge, and we're trading below there. So from a technical posture, and the near-term trend right now in the market is bearish. There's our series of lower highs, including the post-Fed high right there, and lower lows. So next week, I maintain if we could take out that previous low, that should be quite bearish in my opinion. And if we start moving up, anything more than just a pop and crap, if there's some whatever causes the markets to go up Monday, then that starts to incrementally chip away, and more rapidly as higher you get, it starts to chip away at that bearish scenario. But right now, I like what I see, and just wanted to share my thoughts. NASDAQ 100, let's not make it any more. It's just simple. We have a clean uptrend line, bearish rising wedge. We were rallied into resistance at the previous reaction high. It's a level that I fully expected to break based on the negative divergence, and we had the breakdown, and then as I showed you this morning, a textbook rising wedge breakdown and back test. So I'm trying to tune out all the noise, what may or may not happen over the weekend or next week with the central banks or the Treasury Department. I see a breakdown, a back test, and then these are the same levels. If you recall in that video on Friday, I was waiting. I waited till Powell's press conference. I thought it would come, but I told you I suspect I wrapped the video up, and then right after that broke, and that's exactly where I said we'll probably see one big red candle down there, 306.44, and that's what happened. So in other words, things are playing out as I figured they would. We need, it's not objective to short right here because you're above support. That was last week or last few days ago, or even a couple weeks ago. I think I had that level there, 306.44. It was support, and it's still support. TA 101 says you either buy a pullback to support and go long on it with a stop below, or if you're bearish and you think it's going to break, you wait for a breakdown. So that would be your next sell signal. And of course, there's a little extra element of risk added because it's Friday. So no matter who you are, even if you're a futures trader, those futures are going to stop trading later today along with stocks, and the futures will start up again on Sunday night. So you have couple extra days overnight risk. There's that bank report, I forget the name of it, coming out today after the market closes at 4:30 that will tell how much of the deposits the regional banks lost to the big Bank Americas, the big behemoths, JP Morgan, Chase, all those. But that's still where I think we go. And then remember the VIX is still elevated. So these are the levels. I'm seeing a lot of the conditions that are present during the big drops in the market. And again, with the fact that the NASDAQ 100, the market as a whole, especially buying up tech stocks, bringing tech stocks higher than they were before this whole banking thing started, the NASDAQ 100, the risk is there for, again, I think a potential, crash or mini crash or big leg down, and maybe not. But I can tell you from the technicals, the case is still intact. We had this VIX bullish falling wedge. Pointed it out before it broke out, pointed it out on the breakout, pointed it out on the back test here, pointed out again the other day on the back test. I mean, these are even just quick trades. These are all, double-digit pops. If you bought the breakout or the back test, we're up, into today's highs about 19% from the most recent back test. And the VIX by next week will probably either crap out, and then that's it. That was it. The breakout's over, and we go to new lows, or the VIX could explode. I don't know. Again, I don't think I'll head short into the weekend. and it's pretty decent, but it's not plenty room to add. Like I said, I told you before, it's not an all-in moment for me unless the recent lows get taken out, from Monday before last. Okay, and last but not least, I've been updating the FANGs. I told you, this market isn't going to break, nor does it ever break until the leaders break. As long as I may be right in my reasoning that this faith in big tech stocks is unfounded right now as a safety harbor or any type of economic benefit. Maybe the market, because the dot plot, at least not what the Fed's saying, but what the market's saying, the market's forecast is for Fed to start cutting soon. And if that's right, then there's logic that the market's going to rally. Well, I can tell you this: we're in that vicious cycle. To me, honestly, fundamentally, is a no-win situation. The only way the Fed's going to start cutting rates anytime soon is if economic conditions continue to deteriorate. In other words, that the odds of a recession increase, and so therefore there's no positive for especially for big tech companies if we're going into recession. They are cyclical companies. They are dependent on the business cycle. These big tech companies grow in a growing economy, and in a recession they contract and they fall hard. In 2007 to 2008, they fell every bit as much as the S&P 500. They led the way down, and they had nothing to do with the banking system back then either, any more than they do today. But in a down market, in a recession, they will fall. So let me just show you how they look. And again, all my fundamental ramblings may mean nothing, so take it for what it's worth. Just like my technical analysis may or may not play out, but what I showed you the other day is was waiting. We have positive divergence on just about all these FANG stocks, including the big dog here, Apple. Let me show you one more thing. So not just that 60-minute divergence. Remember, we were back here when I first started covering the FANGs last week, saying Apple almost had to get up there and make at least an equal or a marginal new high, and it did that. It made a marginal new high. It broke out. That was pretty good resistance. It was resistance once broken becomes support. That's 157.63. I have a reaction high there, more recently there, almost there, and so here's a little breakout. But then that breakout, if we fall back below there by a good amount, it'll have failed, which I think we will. Odds favor it based on the divergence, in my opinion. And then you have an even better, very well-defined uptrend line. That's the number right there. The trend line, and you have support at 153.80 right there, another decent price support level. So if this happens, it's going to increase the odds that Apple's going down. And so not only that 60-minute chart, but I wanted to show you this. This is the more significant daily time frame. I always put a higher weighting on the longer term time frames. And so you don't get them often, but if you just look at these divergent highs, I have most of them marked. Divergent high was the fourth quarter earnings in Apple. There was that drop that followed. Divergent high correction. That was, by the way, I don't know where my DH letters are. Maybe they're up top higher. Just copy. That was a culmination of multiple divergent highs. Oops, I didn't mean to do that. I need, here, let me just make one up here. Divergent high. All right, so this right here, you had a series of these divergences building, and each one had their own correction, but the divergences got bigger and bigger and bigger, and finally played out for the top and officially kicked off the bear market in Apple. And since then, you've been making lower highs. There's a trend line, which would be my max upside target for Apple right now. Could certainly get there, and probably will if the markets can hold up and rally next week for whatever reason, whether it's something from the Fed or Treasury or not. But that would be an area if the chart's confirmed at the time to short. But let me show you, we may not get there because we have, for the first time in quite a while, pretty clean negative divergence on Apple, especially in a bear market. What happens when you hit that oversold? I have an extreme oversold level right there, overbought, I'm sorry, of 77.20, which is above the typical 70 level on the RSI. That seems to do the trick, even in bull markets for Apple. And then it's usually not that first tag of the level. It's typical. Sometimes it is, but more often than not, you come in and then you make a second lower overbought reading. I'm struggling with my drawing tools as usual. There it is. So you had that divergent high, and then the big drop came. You had that divergent high, and then the big drop came. You had again the divergence continued. Well, at that point the top was in, and so usually in a bear market you get anywhere close to overbought. Even the 70 level will quite often do the trick, and that's when, just like it did there, you got the correction, and now you have again for the first time, since going back to the top. There it is, the first time since on the daily chart. Apple has negative divergence. It's not confirmed. It'll be confirmed if we get a bearish crossover on the PPO that effectively puts in a lower high. If that happens soon, it'll be the first time since Apple topped back here in the beginning of January, along with the rest of the stock market. The NASDAQ itself bottomed in a little before that, and Apple's been one of the strongest holdouts. One of the best relative performers, but it dropped from there 32%. So that's what I'm looking at. And then you go through the rest of them. Microsoft, my lines populate here. Divergent high, daily chart too, by the way, as well as a 60-minute negative divergence. And the last time I had a divergent high on Microsoft was at the top. Okay, so to me, again, I'm sitting here talking over and over, but I'm showing you that the technical case. Technical analysis. Forget about my fundamentals. Well, that'll be right or wrong. But technically, I see a very nice, attractive RR and a case for a much bigger drop than I think most are probably pricing in at this point. There's Alphabet. Look at that big level, 105 right there. It was the bottom of this trading range. Look how many times we hit that level. We had a couple intraday pops, and then boom, finally, when we broke it, the stock didn't look back. Fell hard, made a perfect back test, rejected. Tried to take it out there along with the 200s, but got rejected on that downtrend line. And we're there again. So everything I've been saying for the last couple of weeks, I think the market is a very critical technical juncture. Make it or break it. If it can power on through here, and again, it's incremental, not all or none, but start to get away, and this is Alphabet, but each of these companies start to get away, take out those levels. If Apple can rally up to and take out the bear market downtrend line, great. That's nothing but bullish if it does. But until then, in a bear market with the primary trend indicators, which I started the video out with, the long-term trend indicators, while they are still bearish, that tells me to not overthink things. We're in a bear market unless those indicators start to tell me otherwise. And as such, the strategy should be to short rallies into resistance. And then for loss mitigation on those shorts, next week, like I said, I'll allow a little brief I'll assess the charts as they come. We'll see what happens Monday. But then you start going up and you start to change things. The technicals start to change. QQQ starts to change. That the divergent high that you have right there, that's also on the daily chart of QQQ. I probably should have mentioned that right there. That gets burned through, taken out. Same on the 30-minute chart. You pop resistance, you maybe take out this divergence that we have right now. That was a divergent high post-Fed right there. If that indicator moves up like that, PPO moves up, then you've taken it out, and then it's hard to make a strong bearish case, at least very near term. It doesn't eliminate the long-term bear market scenario, because you've got a lot more upside you need to take out, a lot more levels, key reaction highs, and other things, but it will certainly chip away at the bearish case, especially if you get the S&P 500 back above those 200-day moving averages. Okay, that is it. That's my mindset, and that's why for now, despite the what seems like the market, like I said, really surprisingly holding up well despite everything that's going on right now fundamentally. Again, I think it's my theory is it's just years and years of classical conditioning of the market, learning that the most bullish thing out there, more than Apple blowing away earnings, more than a rosy GDP report, the most bullish thing the stock market can have, and so for the last 15, 20 years now, is a crisis, something bad happen, because then they expect the Federal Reserve to come in with quantitative easing and lower rates and or government backstops, and one day that's just not going to end well. It has just created a tremendous playground of excessive risk taking. It's just a bad thing overall. But we'll see. All right, I'm going to wrap it up here. This has been Randy Finney with Right Side of the Chart. Have a great day.